Welcome everyone to our July 2024 newsletter, where we take a look at the June stats, the stats for the first part of the year, and we try to get an idea of what's happening in the market. Now, there's a lot of strange things happening in the market today, whether we're talking about interest rates, prices, supply, sales to listing ratios. So we're going to dive into the data. We're going to look at it from a macro GTHA perspective. Many of our clients reach out to us after these monthly recaps and ask us to analyze their market or sub-market or building and give them an idea of where they are in terms of pricing. Please reach out to me or someone on my team. We're happy to do that for any one of you. So we're going to talk about in the news, then we're going to get into some monthly market insights. We're going to look at the affordability gap, which we look at every month, and we're going to look at what's hot. Did inflation really increase? So there was a lot of confusion around this when the numbers were released earlier this month. They came in higher than expected, but what happened was Stats Canada from time to time actually changes the basket of goods and services that make up the CPI. And that's exactly what happened in this last announcement. So when you actually factor in what the mortgage costs were made up of, it was 1.3 mortgage interest and 1.6% everything else. So we're in a really good place when you take out interest, which the Bank of Canada actually has complete control over. So, without getting into all the macro and microeconomic factors and key indicators that the government looks at to decide on rates and economic and monetary policy, we can tell you right now that everything is pointing towards a rate cut next week in July. And based on what I've been reading in the market and my understanding of it, I feel very, very strongly that we're going to see 4 more rate cuts this year. So we have 4 more potential rate announcements, and I believe we're going to see cuts all the way up until the end of the year. Call me a forever optimist, but I really do think that's the direction we're going. All right, so let's take a look at the June market statistics. Now, this is the year-over-year change in the different housing types for 416 and 905, which is a very good indicator of the current state of the market. But we'll take it a bit further when we do some month-over-month updates, which can give you a more accurate story of where the market is and maybe what's influencing the market. So, it's no surprise the market has been very challenging with the high rates. And, earlier in the year, last year, I should say, people were expecting rates to come down. We saw some life come back into the market, but that got sucked out very quickly as rates started going back up again. So the detached market in 416 has been pretty resilient with the 1.6% change, decline, I should say, year over year. 905, we saw that a little bit higher at 4.2%. Semi-detached, 8.9%. 905 was 7.4%. Townhouses in 416 were 2.17% loss, decline, I should say, and 5.6% in 905. And condos actually in Toronto surprisingly remained the resilient. Now, there's reasons why they was I guess condos were the less impacted in terms of declines, and we'll get into that later. But Toronto remains to be a resilient market, but it also didn't have the volatility that we saw in the market over the last 3 years or I guess 4 years due to COVID and rate increases and decreases. So I think the way I always like to look at housing especially in the GTA is that every home buyer would love to buy a detached home with a backyard where they can put a pool. But the reality is it's not always affordable. So as money got cheaper, which we'll look at, I'll show you those trends in a further slide. But as money got cheaper, the house type that everyone wanted got more affordable. And we saw a lot of price growth, just after COVID as rates were dropping. And that's really what we saw, where a lot of people bought at that peak, maybe feeling the pain right now. But as we'll look in a further slide, the long-term data suggests very positive things for the market. All right, so let's take a look at the Toronto Real Estate Board average sale price and growth analysis. This is compliments of Roy LePage signature. Chris Slightum, the owner here, is incredible at putting together a market commentary and real picture of what is actually happening in the market. And when you're able to look at long-term trends, it could really give you an accurate perspective in terms of where the market really is and give you a lot more confidence in making decisions in today's market. So this here is a price snapshot in comparison to the 6.8% long-term average. So the Toronto Real Estate Board has historically averaged over a long period of time and shorter periods of time, but over the 45 years it's been tracking data, it's averaged 6.87% average annual growth. So when you factor that in, prices are actually exactly where they should be today. So at 1.162 million, prices are actually $1,336 above where they should be when you look at prices in terms of that long-term average, because that average gives you a snapshot of exactly where the market should be. And if it's not at that point in time, in the market, you can know with a lot of confidence that eventually it is going to meet that long-term average. So people, for example, that bought at the peak here in December 2021, that market was out of whack. We saw double-digit growth, close to some markets experienced over 20% growth. And what happened is that actually pulled back. But when you look at the long-term average over the last 4 years, it's actually a lot less dramatic. And you have that average growth that we would expect over the long term. So, it's so important to look at the long-term data and to hold real estate, if it's an investment, to essentially eliminate the risk. And peaks and valleys, but the long-term average has always been consistent. And prices got out of sync because of low supply and low rates, which is exactly what we saw here. We saw that COVID kicked in around here. The government started really reducing rates. At the same time, supply was already very low before COVID came in and shocked the real estate market and the economy. Prices were starting to really take off because we had a really big shortage of a significant shortage of real estate in the city of Toronto. And we saw prices going up. COVID hit, prices went down. Government interjected and with monetary policy and aggressively reduced rates. And while we all know what happened there, a lot of people went into the market, and price growth skyrocketed here. Like I mentioned previously, a lot of that growth came in the low-rise market because people who could have maybe only afforded an entry-level condo before now could have afforded a townhouse or a semi-detached or a detached because money was so significantly cheaper. And then what happened was the government started increasing rates, and we all know the history of that. But right now, we're actually back in line, and as the market is starting to show signs of stability. This is a good chart that shows monthly sales data. So it gives you a better, like I said earlier, it gives you more context for the story in terms of, year over year growth. And in June last year, we actually saw prices peak out. So probably in April and May, the interest rate pattern of increases had stopped, and the market reacted to that, thinking that we had reached the peak of where interest rates were going to go, and prices actually jumped up again. We saw double-digit growth in many markets across the GTA, just because people were able to qualify at that rate and were comfortable and confident that rates weren't going to continue to go up. But what happened was the Bank of Canada interjected, and you can see that Bank of Canada reacts, and we see a June 2023 rate hike that literally shocked the market with 2 more hikes. And that's pretty much where we're at today in terms of where the rates are. So now we're starting to see rates come down, and I think rates are going to come down further, as I had mentioned earlier. We'll see next week, and I think that's going to be a pattern for the rest of the year. So I think the market will probably react because rates are going to be where they were at earlier in 2023 when the market started taking off. And I think there's a lot of opportunity in the market right now. So if you actually look at all these stats, days on market was very hot last June. You can see days on market has increased throughout the year. And along with it, there's been some price volatility. Months of supply, months of inventory has increased as less people were jumping into the market due to rates. And active listings increase. So this is probably a direct sign from sellers where they thought because rates started coming down that this would be a good time to actually list their property and sell it and prices would take off. But I think what we're seeing here is that the market has not reacted yet because rates still aren't low enough for the majority of people to come off of the sideline. And I think that's going to take probably 2 more, if not more, rate hikes. rate decrease. And I just love this chart because look at this rate increase cycle here. This is the blue dot, and it just ripped through the market. We've never historically seen rates increase like this. And I had a call with an ex-Bank of Canada economist a few months ago, and I always ask people I think that are smarter than me about with finances and lending and policy around rates and monetary policy. I always ask, did you have a variable rate or a fixed rate as rates started going up? And the Bank of Canada, ex-Bank of Canada economist confirmed that he actually had a variable rate. And I asked him why, how was he not able to see what was happening? And they make the decision very last minute, but he said in the history of the Bank of Canada, we've never had such aggressive increases. So for those of you who felt the pain the way I felt it with variable rates, there were people a lot smarter than me that also had variable rates. So the economy's feeling, the market's feeling it, and now the government has made its first decrease since the rate cycle started. And, it's a quarter drop, made very little impact in the market, as I just mentioned. Interest rates drop, but sales and prices pulled back, which is a good sign for Bank of Canada to start cutting further. So what do I mean by that? So the Bank of Canada last year in early 2023 stopped increasing rates to see how the market reacted. And it reacted very aggressively. Prices went up very quickly. A lot of that demand came off the sidelines. So they started increasing again. So this time they did one decrease and the market did not react. Prices did not shoot through the roof, and we got a lot of listings, and the market has been very stable. All right, here we go with the GTA market stats. As I mentioned earlier, if you want us to look at your neighborhood, your building, your house, whatever the case may be, we can break it down and give you a very similar analysis to give you an idea of where you are. Just reach out to me or my team. We'd love to do that for you. We do it for our clients all the time. So listings increased on all housing types as sellers rushed to the market, hoping the market would react to the rate decreases. So I had mentioned that earlier. I don't think one decrease is going to be enough to stimulate the real estate market. The good sign is that there has been a lot of inventory and prices have not been going down. It's been very flat. So I think a lot of sellers thought the market would react. They put their properties on the market, and we just haven't seen those first-time home buyers, those condo buyers who are most impacted by higher rates because they have to get approved at extremely high rates, especially once you factor in the stress test. So once we see rates come down, either, if we say as low as early 2023 when the market did react, that might be all that it takes. But in terms of the average price, we're at 1.162, down 1.6. And when you look at condos, the average sale price is $727,000, down 1.6. As well, condo sales have really been impacted, and we'll take a look at the different areas here. So let's take a look now at the absorption rate. Now, the absorption rate is essentially the amount of time that it takes for all of the inventory to be sold if no new inventory was to hit the market. And it's a really, really good indicator to tell you where prices are going, because typically as MOI, months of inventory, increases, you'll start seeing days on market increase, and you'll start to see pricing decrease. Now, I do it week over week to try to see patterns very quickly, but often there's anomalies in the data. So you can't really take week over week data and make a big decision on it, but you can start seeing patterns when you look at many weeks here. So we've got the long-term average. This is just from March, the last three months or so. And the average for GTA high rise is 4.6 months of inventory, and the price is 728,000. Average days on market is around 30. So average days on market, average price is relatively close to last week. We're starting to see, as you can see here, months of inventory starting to pile up. And, I think rate decreases couldn't come at a better time because condo inventory is at a very big high in terms of what's available on the market to buy. Now, let's talk about that for a minute. So what happened was, COVID had, changed a lot of things, and the construction of many buildings got delayed, and we've seen more completions in the last 8 months than what we've seen in any other 8-month period. So we saw an extreme amount of completions, which we're not going to see most likely in the near future anyway. And I'll get into those numbers shortly. So we're working through that excess inventory. And what we need to really get through it is rates to come down. So we're going in the right direction. And if you look at the low rise GTA, we're at about 3 months as an average, and we're now above average. So you're starting to see prices starting to feel a little bit of pressure. Now, the Toronto high rise, we're at nearly 8 months of inventory, and we're starting to see some downward pressure on pricing. You know, the average is 750 over the last 3 months. We're currently at 711. But if you actually take a look at the last month, we're probably not that far off on the average. So we'll take a look at it again next month. And I think that's probably a seasonal anomaly in the market because a lot of people are on vacation right now and not buying. So this is why it's important to look at the data. And we'll take a look next month. Condo sales have literally fallen off a cliff. And this is what I keep saying is creating such a strong story for future price growth. So these are the numbers recently released for the Q2 report provided by Urban Nation. You can see the 20-year average for new home sales, which is essentially the inventory, the supply that gets added to our market, is right here, just around 6,000 units. Now, we've only had up to in Q2 is 1,688 units. You know, and that was a very similar story in Q1, and I imagine it'll be similar in Q3. So, you know, a little bit further down the road, I think we're going to see a tremendous amount of price pressure based on just supply and demand fundamentals. So sales have declined. 1,688 sales in Q2 2024, down 66% year over year and 70% below the 20-year average. It's the lowest Q2 result in 20 years, excluding COVID-19 period. First half performance. So we saw 3,159 units sold in Q1 2024, a 57% decline from a year ago, making this lowest first half for new condo sales since 1997. So at a time where we need, maybe not today with all of the excess supply that hit the market over the last 8 months, but generally speaking, at a time when we have more immigration than ever, our supply is starting to go in the wrong direction. So that's going to, without a doubt, in my mind, create upward pressure, price pressure in the future. So pre-sale absorption, again, pre-sale, these aren't homes or condos or properties that are currently on the market. These are homes and properties that need to be sold, pre-sold, in order to be added to the market. Inventory increased. Total unsold inventory reached a record high of 25,000 units, 60% higher than the 10, 20-year averages. Unsold inventory is now 34 months of supply. Price stability. Average asking prices for unsold units declined 2.6% year over year to 1,361 square feet. Now, pricing on new homes is going to be very resilient because the price of land is already built into it, but the cost to build is only going up. So right now, that future inventory that's going to hit the market, there's a price level that it has to be resold at. So that is what gives me a bit of a buffer and confidence in the market, because all of that new inventory that hits the market eventually is going to be at a price that is going to drive other prices up further. Completions and construction starts. So this is interesting, and I'm starting to see it when you drive around Toronto and the GTHA. You're noticing a lot less cranes than there was a year ago, and completions for the latest 4-quarter period were 28,000 units. Only 727 new condo units started construction in Q2 2024. So that means those units were sold, those buildings were sold. Now construction is happening. Now construction, that is a very low number for construction. So not only are we seeing low deliveries and low construction starts, but we're seeing low sales, which mean they'll probably never make it to construction. A building needs to hit 70-80% in order to be able to get a shovel into the ground, and we're not hitting those numbers right now. So these numbers are going to, I believe, go down significantly as the market moves forward. So that's a 20-year low. Total condos under construction fell to a 3-year low of 87,000. All right, let's look at the key indicators that I like to look at, the affordability gap. So the average price for a detached home in 416 is currently 1.758, and a condo is currently 763 for a condo. That's a difference of $995,000, just short of $1 million. So historically, the gap has been significantly less than that. And as condo buyers can come back into the market as rates decrease and they can now get approved and qualify and afford the payments, we're going to see, I expect, more demand towards high rise than low rise, because the price difference between low rise and high rise is at near record highs. I always like to look at the 416-905 gap. And, the way I look at it is people always want to own a house with a backyard and a pool. If they can't afford it, they buy a condo in Toronto. Now, if they can't afford a condo in Toronto, they go to the 905. So, when I talked about this earlier last year, there was a very narrow gap. And that's when I said there was an opportunity for people to start buying in Toronto. And that's exactly what we saw. So the gap is pretty wide. So there might be some good opportunities in the 905 right now. But historically speaking, not at the 416 price right now in terms of versus detached, when people want to move to the city, is a very healthy gap. And I think that's an indicator of prices going up once rates start working their way through. What's hot in the market today? Well, Duo Condos is a very exciting project located in Kitchener-Waterloo. For those of you who don't know what's happening in Kitchener-Waterloo, it is mind-blowing if you go down there and you go to this hub. There's a real technology hub with thousands of jobs directly across the road from this incredible master plan community. You literally walk into the sales center and you see a massive Google sign across the road. So you've got thousands of Google employees. You have some of the largest tech companies from all over the world, all within walking distance. It's a really exciting project. They also allow Airbnb. These units are being sold with Airbnb licenses. Very, very exciting project. A lot of our clients have already bought in here. And if you're interested, please reach out to me or the team. Palm View, Punta Cana, incredible project. I've been spending a lot of time in Punta Cana. I'm now investing in there. I've invested in several units. This is a very good opportunity for investors who don't want to invest in Canada for tax reasons, government reasons, whatever reason. There's much more cash flow in Punta Cana. You're buying pre-construction below resale prices, so there's built-in equity, and it's a really exciting investment that I'm going all in on. So if anyone's interested in learning more, please reach out. Now, this is a project I am very, very excited in. I'm actually an investor in the whole project. I'm a big believer in it. I actually own a second home in Blue Mountain, and I spend a lot of time there. It's a great investor market. It's a great lifestyle market. I spend a lot of time there with my family. So I'm very excited about this project. It's going to be launching most likely in fall 2024. It's located right in the village. It's the first development housing to be added to the village in over 20 years. So it's a very exciting project. Reach out if you want more details. Now, right now, there is an incredible opportunity for buyers. Sellers, I suggest stay put, wait for the market, wait for rates to come down further. Let's work through that inventory. And I think we turn that corner and prices start going up. But in terms of buyers, there has never been a better time in my career doing this. I've picked up 4 units in the last 6 months from people selling on assignment. So we have access to dozens of assignments. Many of them are really good deals. There's some great resale listings that we have pricing very aggressively. So it's a really good opportunity for buyers out there right now. Please reach out to us. We have some really great developments and units on the resale and assignment market. As always, please reach out. We'd love to sit down with you and talk about real estate and how we can help you buy or sell your home and help you invest to build wealth for you and your family. Look forward to seeing you guys next month. Thank you for sticking around.